Hello everyone, welcome to my YouTube channel. Today I have come up with something different. I thought I'll make this video a little bit informative one. Before that, I am Arundhati Vimal, a 4th year law student of Christ University, Pune, Lavasa campus. Today with me I have my fellow classmate and my best friend Sonalia to discuss some legal concept related to banking laws and the banking system in India. Sonalia must be familiar to you all, isn't she?
Hello everyone, welcome to our video on a topic that's crucial for understanding our economy, the impact of a global recession on the Indian banking sector. I'm Sonalia and today we are going to break down how recessions affect banks, what the Reserve Bank of India or RBI does in such situations, and what this all means for you.
In the next 10 minutes, we will explore how the principles of banking law come into play during the economic downturns. We will look at specific examples of recent recessions and discuss their implications for banks, customers, and the economy.
A global recession is a significant decline in economic activity spread across countries, lasting more than a few months. It is typically visible in GDP, real income, employment, industrial production, and wholesale retail sales. The 2008 financial crisis and the COVID-19 pandemic are recent examples that had widespread effects on economies worldwide, including India.
To understand how recessions impacts bank, we need to start with some key concepts of banking. Commercial banks have three core functions: accepting deposits, providing loans, and offering financial services like fund transfer and investment products, etc. The Reserve Bank of India or the RBI acts as the central bank, regulating and supervising these commercial banks to ensure financial stability.
During a global recession, banks face numerous challenges. One of the most significant issues is the rise in non-performing assets. NPAs are loans or advances for which the principal or interest payment remain overdue for a period of 90 days. For example, during the 2008 global financial crisis, Indian banks saw their gross NPA ratio rise from around 2.5% in 2008 to over 4% by 2009.
When NPA increases, it indicates that more borrowers are unable to repay their loans. This directly affects the bank's profitability and liquidity, as they have less money to lend or invest. This situation was quite familiar during the COVID-19 pandemic. By March 2021, India's gross NPA ratio was projected to rise to 13.5 under the RBI's baseline scenario, reflecting severe impact of the pandemic on borrowers.
This leads to a liquidity crunch, where banks struggle to meet their short-term obligations and became cautious about lending. For instance, during the 2008 crisis, Indian banks faced a liquidity shortage, prompting the RBI to take immediate corrective measures to infuse liquidity into the system.
This is where the RBI's role becomes crucial. RBI is responsible for maintaining monetary stability in the country, especially during economic downturns. Here are some key measures that RBI can take during a recession.
The first one is lowering interest rates. The RBI often lowers the repo rate, the rate at which commercial banks borrow money from the RBI. Lowering the repo rate reduces the cost of borrowing for banks, encouraging them to lend more to businesses and consumers. For example, between 2008 and 2009, the RBI reduced the repo rates from 9% to 4.75% to boost liquidity in the market.
Second one, providing liquidity support. The RBI uses tools like open market operations or OMOs and cash reserve ratio CRR are the adjustments to provide liquidity support. During the 2008 crisis, RBI conducted OMOs to buy government securities from banks, thus injecting liquidity into the system. Similarly, in 2020, the RBI conducted OMOs worth 2.8 trillion to ensure adequate liquidity during the COVID-19 crisis.
The third measure being implementing loan moratorium. Another crucial step is implementing loan moratoriums. During the COVID-19 pandemic, the RBI announced a 6-month moratorium on loan repayments to provide relief to borrowers. By the end of the moratorium period, over 30% of the total loans in the banking sector were under the moratorium, indicating its expansive impact.
Let's look at some real-world examples of these measures in action. During the 2008 financial crisis, the RBI reduces the CRR from 9% to 5% to increase the liquidity in the banking system. This move alone released the approximately 1,60,000 crore into the banking sector, allowing the banks to continue lending.
Another example is from the COVID-19 pandemic. Apart from the moratorium, the RBI also introduced targeted long-term repo operations to provide long-term funding to banks, specifically targeting investments in corporate bonds, commercial papers, and non-convertible debentures. This was done to ensure that credit flows to specific sectors facing the brunt of the pandemic, like MSMEs and retail.
For customers, especially borrowers, the moratorium and the reduced interest rate provided temporary relief. However, these benefits come with long-term considerations. For example, a customer who opted for a moratorium had to pay additional interest accumulated during the period.
Now, let's talk about the implications for various stakeholders. For banks, these measures help stabilize their balance sheets, but they come with increased risk. For instance, the loan moratorium helped in the short term but led to higher NPAs once it ended.
In conclusion, a global recession possesses significant challenges for the banking sector. However, with robust regulatory measures and strategic interventions by the RBI, these impacts can be mitigated, ensuring financial stability and the economic recovery.
For the overall economy, these measures are crucial in preventing a financial collapse. For example, during the 2008 crisis, India's proactive measures helped it recover faster than many Western economies. However, the long-term effectiveness of these measures depend on proper implementation and regulatory oversight to avoid future financial risk. We hope this video has given you a clearer understanding of how global recessions impact Indian banks and the critical role of the RBI in managing these crises. If you found this video helpful, please like, share and subscribe to our channel for more insightful content.
Thank you for watching.